About 2 minutes to go until the bell. We want to bring in James Knightley, ING's chief international economist, and also Jack Manley, global market strategist at JP Morgan Asset Management. Our markets reporter, Jared Blickery, is also standing by here as we head into the bell. And Jared, since the last time we spoke, we saw the NASDAQ flipping back into positive territory. What's driving the action?
That's right. Well, just kind of a knee-jerk reaction after dipping in the red. It's not a big movement. And to be fair, stocks really haven't moved a lot today, although the NASDAQ was up about 1% at its peak. The Russell 2000 down about 2%, but you can see just about unchanged here going into the close. And we'll take a quick look at the Russell 2000 off of its lows where it was down about 2%, only 1.6% now. Dow and S&P 500 down slightly. Do want to turn to the bond market, which closed just about an hour ago. We are up 1 basis point in the 10-year T-note yield, and also want to check on the VIX because volatility has been waning here. But nevertheless, you got to not worry, but you got to pay attention when the VIX hits 20 because it has rebounded from those levels before, which means risk markets could suffer. Let's take a look at some stocks heading into the final minute here. We got Apple, Alphabet, Facebook, and Microsoft all up 1%. Facebook nearly 2%. Some of the biggest losers here, Zoom and Tesla, each off more than 4%. So some of those old high flyers stumbling again into the close. Well, let's take a look at the travel sector. That is still in the red, and some of those losses accelerating. Carnival and Royal Caribbean, those cruise lines down about 5%. Airlines not as bad. Americans off about over 2%. United almost 2% right there. I had some interesting words from Goldman Sachs today, liking Alaska Airlines and American Airlines to play that sector. Well, here's a look at the sectors heading into those final seconds. Communication services and tech are the biggest outperformers. Communication services, which houses Facebook and Alphabet, up 1% here. Here's a closing bell.
All right, we got a closing bell, and here's where it looks like we will settle in the markets today on Yahoo Finance Live. We're going to see the S&P 500 probably settle down barely a 0.25%, be off about 5 points. The Dow's going to be off almost 0.5%, down about the NASDAQ will end the day. It will be positive, roughly 12 points. Some of the sectors that we're keeping an eye on here, consumer discretionary, that sector is going to finish down almost 1%. If you dive into some of the industries that we're talking about here, hotels, restaurants, and leisure, they were off about a little over 0.5%, but year to date, they're up 7.9%. We go to our guests to talk about where we are headed in these markets, and let's start with Jack Manley. Jack, I want to talk with you about this FOMC statement that we'll get tomorrow, and think that the markets are really setting themselves up for a disappointment and perhaps even a sell-off tomorrow?
Well, to my mind, I think about what the Fed's going to be coming out with tomorrow, and generally speaking, I think the best move is no move. I mean, certainly we're not going to see any immediate changes to policy, but I think markets are kind of anxious about the language that the Fed will be using to account for the fact that things have been a whole lot better than I think initially anticipated since at least their last meeting. You have more stimulus than expected, a more successful vaccine rollout than expected, a more resilient labor market that's bounced back faster than expected, and of course, oil prices that have risen, I think, a whole lot more than was expected. So the best thing I think we could get out of the Fed is an acknowledgement that growth is picking up, that the recovery story is more durable, that the worst is behind us, but that there is no immediate pressing risk of inflation. I think if we hear something like that out of Jay Powell, if that's reflected in the language, if it comes out during the press conference, that's the green light for investors to keep this party rolling.
James, what do you think we'll likely hear from the Fed tomorrow, and what are you hoping that we'll hear from the Fed?
Well, yeah, I think, to be honest, we should be looking for pretty much as much stability as we can get from the Fed tomorrow. I think, when you've sort of been reading through Jerome Powell's speeches for the last couple of weeks, he's been talking more and more about financial conditions, concerned about tighter financial conditions and their feedback on the economy. And certainly the ECB as well in Europe has also been taking a similar line. So I don't think he'll want to do anything that can lead to those bond yields picking up in any meaningful way. So very much a steady hand, steady state. Again, emphasis that there's a lot of slack in the economy and we've still got a long way until substantial further progress has been achieved. And that would be what we need to see to get the trigger point to get some change in the Fed stance.
Jack, when you take a look at where markets are, yes, we're off of record highs today with the Dow and the S&P both closing in negative territory, but any concern there that the market's gotten a little too ahead of itself?
Well, when you look at it from a valuation perspective, things certainly do look expensive. I mean, there's no getting around that. But one of the things we continue to see that I think is very interesting in markets is that there is still a pretty large dispersion in terms of valuations within the broader market. There are still actually some value opportunities out there. So if I look at high valuations in aggregate, if I look at record high prices, at the average level, that is sort of an issue. But I think we look to things like energy, look to things like industrials, even to some extent look to things like financials. There are still opportunities out there. So the market doesn't scare me as of yet.
James, I want to talk to you about some of the retail figures that we're getting. And when we talk about this economy opening up in the second half, I had mentioned to a guest last hour I was going to ask you this specific question. It actually seems like we've opened. That perhaps investors are missing the opportunity now. What do you see coming down the pike, especially when you look at retail?
Yeah, I mean, I think there may be some fatigue. I mean, we're all fed up of having to buy stuff. We want experiences, and I think that's going to be the big change that we're going to see. We're getting the reopening, as you say, coming through now. There's a lot of stimulus as well, and I think it's interesting. You look at the stimulus. That $600 check totaled about $166 billion. Well, retail sales only rose $40 billion or so in the January and actually fell back in February. So there's a lot of spare ammunition from that still to be spent. And indeed, with another $1,400 check hitting bank accounts now, household balance sheets are in fantastic shape. Credit card borrowing is at 4-year lows. Cash, checking and savings deposits have risen by $3 trillion for the household sector since the end of 2019. There's a huge amount of money out there that is going to be seeking a home. And that makes me very, very upbeat about consumer spending. I think, we're going to be shifting away from physical retail and I think much more about experiences from now on.
James, we hear you loud and clear, but Jack, I got to ask you, that huge amount of money, that's the inflationary pressure that the Fed's going to be signaling us tomorrow, isn't it?
Well, it could be. And I think James has already brought up, which I think it makes a whole lot of sense, that there is still an enormous amount of slack in the economy. You think about the output gap in the trillions. You think about the unemployment rate still very elevated, especially when you consider what's happened with the participation rate. It's going to be hard to budge the needle on inflation, at least in the short term. But as the economy does start to normalize and things continue to improve and that slack is reduced, which maybe is a back half story in this year, that is when inflationary pressures could start to bubble. I mean, there are still structural anchors out there for inflation, things like our very large trade deficit, the fact that we have this rise of e-commerce that has empowered us as consumers. But all that money sloshing around, it's got to find a home somewhere, and it very likely will find its home in goods and services, which could put upward pressure on prices.
James, we know China was hit by the pandemic first, severe lockdowns over there. Their economy is much further along in terms of the recovery story than we are here in the U.S. However, the last couple of months, we've seen that recovery slow just a little bit. Is that indicative of what we'll likely see here, or how are you looking at that?
No, I mean, there's been a bit of wobble in some of the Chinese data, but again, lending data is starting to pick up once more. So I think, the Chinese authorities are going to keep that show on the road. But, in the US, we're looking, as I said, we've got a situation where households' balance sheets are in fantastic shape. There's more money coming in their direction. Job opportunities are going to be improving as well. And on top of that, we've got the prospect of a, $3 trillion plus Build Back Better program coming through. And that can really help maintain that momentum. So I remain very encouraged about the US growth story. I think, the European story is the one which I'm a little bit more concerned about.
James Knightley, ING's chief international economist, and Jack Manley, JP Morgan Asset Management global market strategist. Thanks to you both for hopping on here and joining us today.